Welcome to Limit Up, the weekly capital market podcast. My name is Don Collins. I'm a chartered accountant and business advisor of 30 years and partner at Findex, a leading financial advisory and accounting services firm based in Australia and New Zealand. I'm here with Ian Reynolds, trader and investor, former bank foreign exchange market maker and early investor in Bitcoin. Ian, welcome again this week.
Hi Don, nice to see you.
You as well. Making money in stressed capital markets is tough. A typical investment portfolio will often fail. The world is moving into really challenging times as the US tries to address US $40 trillion in debt, contradictory fiscal and monetary policy, internal conflict, and numerous wars. And the rest of the world starts to consider a new global reserve currency, a multipolar world, and aging demographics. So how can we understand what's going on in geopolitics and macroeconomics? Today, Ian is here with his latest press release. Are yields about to blow up? Tell me, Ian, are they?
Well, they kind of sort of have a little bit already. I mean, we obviously know that Japan's have a lot, and the US rates are like a magnet to the upside at the moment, with Treasury and the Fed manipulating markets to stop them going higher. We had obviously the intervention by the US Treasury 2 weeks ago, and it's kind of taken a few days to sink in, but I think it's really spooked investors because it's all very well to throw your muscle about, but it's a clear indication that it's a really big problem that's out there. As you noted from our notes, it's now $40 trillion, not $39 trillion. And so it just keeps on going up. And the US is spending even more money now. I mean, we won't go into those numbers. But yeah, so rates are pushing up. They've been pushing up worldwide, as we will see on the charts. And are we going to experience a Japan type situation everywhere in the world, or in the Western world, is what I'm conjecturing. Really, the question is that Japan has been facing in the last 2 years is, does it support its government bond market, or does it support its currency? Because at the moment you can't do both, i.e. your currency is weakening. This is the end. The currency has been weakening, but rates have gone up. That's what happens in third world countries. Normally, when rates go up, your currency appreciates because your rates are now comparably higher than others. So when you see, and this is what creates hyperinflation, when you let rates go up and your currency go down, it always ends badly. And that's what the situation Japan has been trying to address. And it seems that the US might be in that situation too.
So if the US long end yields remain high despite the Treasury and Fed support, is the bond market starting to reject fiscal policy settings?
Yes. It's rejecting $40 trillion in debt. It's rejecting massive budget deficits continually. It's rejecting reckless spending on everything. The man that set up, what was it? Did he call it the Peace Board or something? Trump started a war and lost it.
Yes.
I mean, this is just ridiculous. And so markets can put up with a lot, but I sense that the people that invest in bonds, who are institutions like life insurance companies or any insurance companies, lots of different funds, so it could be investment funds, it could be pension funds, all of the more traditional investors are beginning to get spooked, because if the bond market pukes, everyone is going to lose money, because government bonds are the collateral of the world.
And you mentioned in your release about the Fed buying and leaving them as on the collateral account with banks. If the banks are given more collateral to lend against, is this genuine stimulus or a sign of stress in the financial plumbing?
I think it's a deal between Treasury and the Fed that someone's got to buy all of the debt that we're issuing. I think it's something like $9 trillion in 2026.
Right.
So they've been pushing short end of the curve, i.e. bills out to 2 years, been issuing lots of bills rather than longer end bonds, because at 30 years it's completely untethered. There's nothing to anchor it to anything, whereas at least out to 2 years it's got to have some sort of relationship to overnight money or Fed funds or what we would call the cash rates, right? At least it's anchored by something. But if you're selling all of those bills, then someone's got to buy it. And the Fed, if you remember, Mr. Powell came in and suddenly said, "Oh, yes, we need to buy more bills so that we can put some reserves with banks that they can lend against, because there's not enough reserves in the banking system." Like, no one really had noticed or was asking for it, but it's a very clear way that Treasury and the central bank can work together to keep buying both the short end and the long end of the market, therefore manipulating rates right across the curve.
You'd mentioned about the 30-year yield hasn't been this high since '08. Can the rising 20 and 30-year yields force a shift from inflation control to debt servicing control?
I think the problem with it being so high is not the fact that the actual number, which is 5.25%, because actually traditionally that's very low. The problem is it's been down to zero, or let's call it 1%. And if everybody in the world has to buy those bonds at a yield of 1% to lend against, to do collateral with, or to hold, because that's how the banking system works, that means as it goes to 5%, everyone's taking a massive haircut on it. If you remember, probably a month ago, the Japanese insurance companies pretty much refused to buy any more Japanese government bonds because they made such huge losses on the ones they bought from when yields were 25 basis points or less than 1%. So, there's only so much you can bail out a system until it all implodes. And unfortunately, everything is connected with particularly US Treasury bonds.
The other thing in your release goes to Scott Bessent and acknowledging he's the best man for a difficult job, but with midterms coming up and Trump's popularity at an all-time low, he may have to take one for the team. If he is removed or politically weakened, would markets treat that as a loss of fiscal credibility?
Probably, but, well, definitely. Definitely. Markets like Bessent because he knows how markets work, unlike anybody else there. But that's not necessarily what Trump will be thinking, will it? Because Trump only thinks of himself. And if someone has to leave to save Trump, then they have to leave. Like his advisor, Caroline, what's her name, left all of a sudden. And we're seeing lots of fractures in the administration. So Vance, the deputy, is now saying the US dollar shouldn't be part of the global reserve currency, shouldn't be the global reserve currency. And that is clear messaging coming out that they're thinking about the question, is it the dollar or the bond market? Which one do I save? Like in Japan, is it the yen or is it JGBs? So they've already telling us they're not going to sacrifice the bond market, but they might sacrifice the dollar if they have to.
Anything else out of the release you wanted to highlight?
Not particularly out of the release. There's lots of other stuff going on that we'll talk about a little bit later.
So go to your charts for the week.
Yep. All right. So as usual, we'll start with crypto. As you can see, Bitcoin is going absolutely nowhere. In fact, stunningly stable, much more stable than the dollar. Same with Ethereum. They're at their lows in the cycle. Will we see new lows? I think probably we will, but currently nothing happening. Oil. Brent, this is we're looking at. So oil has come right off and then spiked again and then come back down again. So it's tending towards its risk-free rate, i.e. war-free rate, because there's plenty of oil in the world. Everyone's had plenty of time to secure other sources, and it's settling in at quite an expensive rate. So that's, if nothing else, inflationary. With a lower dollar, gold has gone up, as we know, in the last week and is stabilizing. It's broken 2 resistances and has the big third one to go. Silver has already broken through that downtrend, but is currently treading water, so not much going on there either. The US dollar is the most important thing, as usual. So I've made it a bit easier to see, I think. So the greyed out bit is the 15-year trend supporting the dollar. It has recently broken below the trend and then returned into the trend. But as you can see here, it is now going lower within the trend. So we're looking for a breakdown below, 98 and a half to really see some acceleration. We've seen dollar yen come off a little bit this morning, but as we've discussed many times, it's like a magnet back up to where the Bank of Japan has been selling dollar yen. So 164 was the last time they sold it. What's that there? That is 160, and just below that 159 are the times they've sold it aggressively in the market. We're at 159, nothing really has happened except they burnt, hundreds of billions of dollars, possibly unnecessarily. So the dollar is lower. We'll just take a look at the stock markets, which, contrary to all the doom sayers out there, seem to be doing all right. So if we look at, we've got SpaceX up there just for a bit of fun. Big recovery, went down to almost 100, so lost half of its value and has bounced a bit. The S&P 500 is at an all-time high, so our cross resolved itself to the upside. The Nasdaq is almost doing the same sort of thing, and the Dow Jones is pretty much at the all-time high as well. So stock markets are doing well because they're sensing that cheap money is coming, i.e. rates are going to get cut despite higher inflation, which we'll talk about in a minute, and despite the fact that Mr. Walsh says he's not going to cut rates. But they're saying, I don't believe you. So going back to rates, this is the German government bonds, which are pushing up to highs. The same could be said for Australia, that we've got highs. The same could be said for Japan, and we'll see something completely different. As we've seen, look, it's actually up here, if you can see that. So it's now 292 on the 10-year and 407 on the 30-year. So pushing right up again. So challenging the central bank and now the US Treasury. US 10-year. This is the danger. This is another long-term trend. And are we bouncing up? We are. So we've come up from 393 to 468 in quite a short period of time, but rates are moving up. 3 Fed cuts and rates have gone up significantly. In the 30-year, you can see there's a good support line, and it's just a one-way stream at the moment. So all rates are pushing up, and it just hurts everybody. One of the things last week we saw was that US CPI came in slightly lower than expected, but core annualized CPI, headline CPI annualized was 3.4%. So 1.4% above the Fed target, which is 2%. So when Mr. Walsh says they're going to get that inflation down to 2%, they're not going to be cutting rates anytime soon, according to what he says. The US did a 30-year auction on Friday, came in at the highest rate for 15 years, or no, 2001, I think it was. And Vance thinks the US dollar shouldn't be the global reserve currency. As I mentioned earlier, he's said that quite a few times now. Trump, of course, has to be the dollar bull. We love being the reserve currency, but you can see the positioning is coming in where we've had to make a choice, chaps, and we've decided that we can't afford to let the bond market run away. So the dollar is going to fall. It's not such a bad thing, but the way Trump thinks, it will be a disaster for him. His own currency gets booted off global reserve. So I get the sense that Trump now is backed into a corner, and if there's a financial disaster, he will throw Bessent under the bus, undoubtedly. But going into the midterms in November, just about now, you have to say Trump has got nothing going for him. He hasn't achieved anything whatsoever. His ratings are at its lowest, and he's got more problems than he started with, including a war that he didn't want to have. And curiously, Rand Paul, who is a US senator, did an inspection of Fort Knox last week, and apparently all the gold's there. Of course, he hasn't ordered it or anything, but he's seen some shiny bars that may or may not be gold. I'm sure they are. But quite clearly, the chess pieces are moving around now, and that some sort of emergency action could be taken. So a revaluation of gold could create trillions of dollars for the US government, which would allow them to not have to issue any debt for a couple of years. Might buy them some time. It's a free option because they've got the gold, apparently. Be fascinating to see what is inside Fort Knox.
Would be, very. We all want to see what's in there.
Yep, indeed we do. Yeah, so all I was going to say is Reserve Bank of Australia kept rates unchanged last week. I don't think anyone was particularly surprised about that. This week we've got UK CPI, EU CPI, the FOMC meeting from last meeting, which will be interesting. So not much really in terms of numbers, particularly out of the US. Oh yeah, and US retail sales on Friday came in a lot lower than expected. So they actually fell, which is very unusual. So we're seeing a real change in market conditions and sentiment and geopolitical positioning. So change is about to come, I think.
Okay. So not yields about to blow up, but a change is about to come.
Well, I don't think the yields are going to be allowed to go up, which means everyone has to let their currency go. But as we're comparing each currency with each other, you can say it doesn't matter. The only thing it does create is hyperinflation because the purchasing power of your currency collapses, and all Western countries anyway on the fiat system have to print money right, left, and centre.
Anything else for this week before we wrap it up?
No, that's enough from me, I think, John.
Okay, well done. Thanks again, Ian, for illuminating us on this week's events. That's another wrap of this week's Limit Up podcast. This and previous podcasts can be located on the Siberia Capital website. Alternatively, you can subscribe by accessing the link at https://siberia.capital/contact. Thanks, Ian, again for this week, and thanks to the listeners.